Welcome to the Economist in Your Ear podcast. If I told you people were paying the price of a luxury sports car for a mischievous-looking furry elf doll, would you call it a clever investment or proof that we've completely lost our minds?
Well, I think most people's initial reaction would definitely be the latter. I mean, we're looking at a phenomenon here that really challenges all our basic assumptions about how things get their value. And, the mechanics behind it are actually way more sophisticated than just some silly retail fad.
Right. Which is exactly why we're unpacking this today. We're looking at a fantastic article titled The Staggering Strangeness of the Labubu Bubble. And the goal for us today is to really deconstruct this specific speculative mania.
Mm-hmm.
We want to examine how this absolute frenzy over a plush toy honestly mirrors some of the most infamous financial crashes in history.
Yeah, it really does.
And this is the fascinating part, we're going to explore the underlying corporate strategy of the company that actually chose to basically engineer the assassination of its own bull market.
Yeah, that corporate angle is really the anomaly here. I mean, we are so conditioned to view market collapses as, tragedies, right? Or failures of regulation.
Absolutely. Everyone loses their shirts and people are crying on the trading floor.
Exactly. But here, we have a deliberate, highly calculated deflation of a bubble by the very entity that, stood to profit from the hype in the first place.
It's wild. But, okay, let's start with the asset itself, right? Because we have to talk about what people are actually buying.
Yeah.
It's the Labubu doll, manufactured by this Chinese company called Pop Mart.
Right.
And the article, it paints a rather intense picture of this object. I mean, it asks you to picture a baby elf in a onesie, but then it goes totally out of its way to describe it as having sharpened teeth and looking, quote, possessed by the devil.
Yeah, I feel like we should probably reframe that aesthetic judgment just a little bit.
You don't think it looks possessed?
I mean, I think The Economist is leaning into a very harsh, almost like pearl-clutching description of the toy. The character isn't actually meant to be demonic.
Right, it's just edgy?
Exactly. Within the context of modern designer toys, it's much better understood as leaning into a mischievous, sort of subversive cultural trend. It subverts the traditional, saccharine cuteness of a standard plush toy by just adding this slightly unsettling edge to it.
So the aesthetic choice is totally deliberate.
Yeah, but the real puzzle here isn't the design. It's not about the teeth. The puzzle is the economic reality surrounding this little object.
And that reality is entirely defined by the absolute insane prices changing hands. Like you see plenty of people walking around with the small versions of these dolls, clipped to their keychains or whatever.
Yeah, they're everywhere.
But if you walk into a Pop Mart shop in London, you can purchase a 40-inch Mega Labubu for £850, which is roughly, what, $1,150?
Over $1,000, yeah, for a manufactured plush toy.
That is a steep premium.
Yeah.
But the market, it pushed way, way beyond just retail. Back in June, a Chinese auction house sold a 4-foot-tall Labubu, which was curiously described in the catalog as human-sized, by the way, which is a bit creepy.
A 4-foot human.
Yeah. Anyway, they sold this human-sized elf for a mind-bending $150,000.
Wow. Just $150,000
Right.
for a synthetic collectible that has absolutely zero utility.
Nothing. It does nothing. Which brings up a fundamental question about market valuation, I think. Because with traditional speculative assets, there is usually some metric to ground the discussion, right?
Right, you have a baseline.
Yeah, like if we look at a tech stock, we can analyze the underlying annual earnings, the projected growth, the market share. You and I can sit here and argue if the multiple is too high, but the underlying data exists.
The match is there, yeah.
So how do we even begin to measure a bubble when the asset is a stuffed toy? I mean, isn't this just the Beanie Babies craze all over again, but simply adjusted for modern inflation and, internet velocity?
It definitely shares the behavioral DNA of the Beanie Babies craze for sure. But I think what we are witnessing here are the textbook mechanics of a speculative mania, and it's operating on this highly, highly compressed timeline. In classical economics, a bubble forms when the price of an asset diverges wildly from its fundamental value. You mentioned equities earlier, so euphoric traders bidding up a company's stock to some completely unsustainable multiple of its actual earnings, that's a bubble we all recognize.
Classic tech bubble. Yeah.
Exactly. But The analytical problem with the Labubu is, how do you evaluate a bubble when the intrinsic fundamental value is mathematically zero?
Because it generates zero cash flow.
Right.
It pays no dividend, and it offers no utility beyond, sitting on your shelf and staring at you with its 9 little teeth.
Exactly. It is a pure zero-yield asset. Now, gold famously generates no cash flows either, right? Yet it serves as this globally recognized store of value.
Sure, but gold has a bit more history behind it.
Well, that's exactly the difference. Gold has literally millennia of human consensus and metallurgical scarcity backing it up. These designer dolls have, what, a few months of algorithmic internet momentum?
TikTok trend, basically.
Yeah. So the true economic puzzle is evaluating an asset whose entire premium is dictated entirely by momentary collective exuberance. I mean, any price paid above the raw cost of the polyester, the plastic, and the factory labor is purely psychological.
It's just collective imagination. We're just deciding that a 4-foot fuzzy elf holds the equivalent value of, like, a mortgage down payment, or even a small house in some markets.
It really is. And the greater fool theory is very much at work here.
Explain that for us real quick, the greater fool theory.
Sure. So the buyers aren't necessarily purchasing the $150,000 doll because they actually derive $150,000 of aesthetic pleasure from looking at it.
Dude, I hope not.
Right. They are buying it under the assumption that an even greater fool, an even more enthusiastic buyer will come along and pay $200,000 for it next month. The value is entirely reliant on the persistence of the hype cycle.
And that kind of irrational premium inevitably creates a vacuum, like an asset commanding massive sums based purely on perceived authenticity and scarcity. That is basically just an open invitation for opportunists to flood the zone.
Oh, absolutely. It is a structural inevitability in any booming market. Think about it. The margins on producing a synthetic plush toy are incredibly low anyway.
Because it's just fabric and stuffing.
Right. So the profit delta for anyone who can, bypass the official supply chain and just make their own is astronomical.
Which brings us to the most entertaining part of this whole saga, in my opinion. The article draws this really fascinating historical parallel using Charles Kindleberger's classic 1978 book, Manias, Panics, and Crashes.
A classic for a reason.
Yeah. And Kindleberger noted that during a boom, quote, fortunes are made, individuals wax greedy, and swindlers come forward to exploit that greed.
Wax greedy, I love that phrase.
It's perfect. In the 19th century, this manifested as fraudsters selling these totally worthless shares in non-existent railway expansion projects.
All right.
Right? But today, the modern equivalent of the railway fraudster is the creator of the Labubu.
The Labubu, yes, the counterfeit Labubu.
The bootleg market has scaled so incredibly fast alongside the legitimate one. And these Labubus, they're generally characterized by sloppy paint applications, subtle manufacturing errors. But the primary tell for a fake, the way you know you've been scammed, is the dental work.
The teeth.
The teeth. A genuine Labubu has exactly 9 teeth. The counterfeits frequently miscount. And the scale of this shadow market is highly documented now. British border officials actually reported seizing £3.5 million worth of counterfeit toys in just the first 9 months of 2025.
That's a staggering number.
And fully 90% of those seizures were Labubus.
I mean, let's just consider the logistics of that statistic for a second. Millions of pounds worth of inventory. That represents actual shipping containers full of fake dolls moving through international supply chains.
It's not just some guy in his garage.
No, not at all. This points to highly organized manufacturing operations actually pivoting their massive assembly lines just to capture the premium created by Pop Mart's hype.
Wow. But let me push back on this a little bit. Are we applying the term swindler too broadly here, though? Because the historical financial fraudsters that Kindleberger studied, like the men selling the fake railway bonds, they instigated severe macroeconomic panics that ruined actual institutions and, devastated ordinary citizens.
Right, they crashed economies.
Yeah. But a factory producing bootleg plush toys with 10 teeth instead of 9, that doesn't exactly carry systemic risk, does it?
Yeah.
Are they really swindlers on a historical scale, or are they just everyday opportunists riding a silly internet trend?
Well, you're right that the scale of the fallout is fundamentally different. Like, a counterfeit toy operation is not going to collapse the global banking sector.
Thank goodness.
Right. However, the underlying mechanics of the market disruption are actually identical. Counterfeiting does not just siphon off a few retail sales here and there. It actively destabilizes the core foundational pillars of the collectible asset itself.
Because the asset relies entirely on verifiable scarcity and unquestioned authenticity to maintain its price floor.
Exactly. If the market is suddenly flooded with visually identical fakes, the buyer's confidence just evaporates. The secondary market freezes because buyers can no longer trust the asset's provenance.
If I can't tell if it's real, I'm not paying $1,000 for it.
Precisely. So Kindleberger's theory applies perfectly here, even without the systemic economic risk. The human psychology, the way market participants wax greedy and completely bypass normal due diligence during a boom, it functions exactly the same, whether the asset is a 19th century railway bond, a modern cryptocurrency, or a fluffy elf doll.
The psychology is identical.
Yes, and the introduction of fakes forces the market to expend massive resources on verification.
Which creates the highly absurd reality of British customs officials in high-vis gear, cracking open shipping containers at the port, and meticulously counting the tiny plastic teeth on thousands of plush elves just to protect the integrity of a secondary toy market.
I mean, it's a hilarious visual, but it really highlights how fragile the market's infrastructure is. But historically, a shadow market of counterfeits like this merely weakens a speculative bubble by eroding trust over time. It rarely triggers an overnight collapse completely on its own.
Right, because traditionally we look to macroeconomic shifts to pop a bubble of this size. There's that old share traders adage that notes that bull markets don't die of old age. They are murdered by central banks.
Right. The money supply tightens, speculation becomes too expensive, and the irrational exuberance just drains out of the system.
But the laws of equities and central banking don't really dictate the lifespan of designer collectibles. This specific market faced a much, much more direct intervention.
A fascinating intervention.
Yeah, the Labubu bull market was an inside job.
Yeah.
Pop Mart, the actual creator and primary beneficiary of the doll, deliberately assassinated its own hype cycle.
Which is crazy because the strategic mechanics of this decision go against almost every instinct of modern brand marketing. Usually a brand seeks to prolong hype indefinitely.
You want to ride the wave forever. But the data on Pop Mart's intervention is staggering. They made an intentional corporate decision to increase plush toy production across their lines, specifically targeting the Labubu by a factor of 10.
10 times the volume.
They cranked the factory dials to maximum and just began churning out roughly 30 million units a month.
Unbelievable.
They intentionally flooded their own market, and the resulting metrics show a total, absolute collapse in momentum. Global Google searches for the term Labubu have dropped 90% since July.
Wow.
Yeah. The frenzy at retail locations just evaporated. Shop assistants in London report that the hours-long queues for the weekly stock raffles are just a thing of the past. If a store receives a delivery on a Saturday morning, sure, it will sell out by the afternoon, but the manic urgency is dead.
The fever broke.
Completely. And furthermore, the secondary market of scalpers has just totally collapsed.
Well, of course. They systematically eradicated the scarcity that fueled those $150,000 auction prices.
So let's view this through the lens of, say, a luxury fashion house to try to understand the logic. If Hermes took their Birkin bags, which is an asset famous for its artificial scarcity and massive secondary market premium, and they suddenly just pumped millions of them into discount department stores.
It would ruin them.
It would destroy their brand equity overnight. So why would Pop Mart voluntarily flood the zone? It really seems like they are killing the golden goose just as it starts laying these massive golden eggs.
Yeah, the luxury fashion analogy really highlights the tension there. But you have to remember, Pop Mart operates under a completely different incentive structure than Hermes. The distinction we really have to draw here is between the consumer market and the financial market.
Okay, unpack that for me.
So Pop Mart is not a boutique operation relying on the mystique of a single item to survive. They are a massive, publicly traded company with a diverse portfolio of intellectual property. And more crucially, the secondary market does not directly benefit their balance sheet.
Ah, right. So a scalper purchasing a doll at retail for $50 and then flipping it online for $1,000, that provides zero additional revenue to Pop Mart.
Exactly. The company only captures that initial $50.
They don't see a dime of that $1,000 markup.
Not a dime. And not only do they not capture the profit delta, but the secondary market actually creates a massive unmanaged liability for the company itself.
How so?
Think about the institutional investors, the massive funds holding large positions in Pop Mart's actual corporate stock. They loathe unpredictability. If a company's multi-billion-dollar valuation becomes intrinsically tied to a frenzied, highly volatile bubble in an unregulated secondary toy market, those investors get very, very nervous.
Because they know that all speculative manias eventually end, and the fallout is rarely contained nicely.
Right. When a bubble bursts organically, whether that's from consumer fatigue or, as we discussed, a massive influx of undetected counterfeits, it taints the underlying brand. The company becomes associated with financial losers, crashed markets, and a cultural fad that has basically passed its expiration date.
Right. Nobody wants to be the Beanie Baby company after the crash.
Precisely. So Pop Mart recognized that the Labubu bubble was a long-term threat to their corporate equity. By seizing control of the supply and deliberately flooding the market with 30 million units a month, they essentially engineered a controlled demolition.
That's brilliant, actually. They dictate the exact terms of the crash.
Yes.
And the collateral damage is entirely confined to the scalpers who are holding these massive inventories of overpriced dolls.
And, from a corporate standpoint, the scalpers are a completely expendable demographic. Pop Mart doesn't care about them. Now, the intervention did impact Pop Mart's valuation in the short term. Their share price fell to roughly half of its August peak.
That's a significant hit.
It is, but what remains after that haircut is a stabilized, predictable business model. Institutional investors will always prefer a company generating reliable, steady revenue from high-volume retail sales over a company whose valuation wildly fluctuates based on whether a 4-foot plush toy sells at a Chinese auction house on any given Tuesday.
It is a truly remarkable pivot. They transitioned a chaotic speculative mania into a sustainable retail operation, and the fallout was just cleanly contained. I mean, the broader economy remains completely unaffected by the fact that thousands of toy scalpers are now stuck with garages full of depreciating mischievous elves.
Yeah, they're just holding the bag.
Exactly. And if someone out there listening still desperately wants a 40-inch Mega Labubu, patience is really the only requirement now. The days of paying a $1,000 premium to a reseller are ending. The retail shelves are being restocked as we speak.
Buyers simply need to remember to count the teeth before completing the transaction.
9 teeth. Not 8, not 10. Just 9.
Keep counting.
It really leaves us with a provocative final thought, though, about the nature of our own portfolios and the things we value. We dedicate immense energy to tracking and obsessing over the value of our assets. But the Labubu phenomenon exposes the absolute fragility of perceived value.
It really does.
I mean, if an asset's worth can be conjured out of thin air by the collective imagination of the internet and then methodically destroyed a few months later simply because a corporate board decided to increase the output of a factory line, we really have to question the inherent stability of the things we consider valuable in our daily lives. Are we building wealth on solid fundamentals? Or are we just clutching our own versions of a furry elf doll, relying on the hope that everyone else keeps believing in the illusion? Thanks for listening. Follow us for daily insights into world affairs, and don't forget to like, comment, and share.